Good morning. Can everyone hear me okay? Okay. It always amazes me what people will wake up for in Washington, D.C. I love it. So I'm David Schleifer. I'm the Associate Director of Programs at the Peterson Center on Healthcare. The Peterson Center is a philanthropy that works to make more affordable, higher quality healthcare a reality for all Americans. I lead the Peterson Center's portfolio of projects that are focused on employers. And our goal is to empower employers to be more effective healthcare purchasers so that they can deliver lower cost, higher quality coverage for workers and families. The Peterson Center is really excited to be supporting CHEER's work on ERISA, including this event, the publication that's coming out today, a series of publications that will come out during the fall, and several upcoming webinars. So why are we supporting this event, and why are we so excited to convene this conversation about ERISA? ERISA was enacted in 1974, so it's been around for a long time. It has always required that health plan fiduciaries spend plan assets wisely, and bars them from paying more than reasonable compensation to service providers. But the law has drawn new scrutiny over the past few years. Partly that's because of the Consolidated Appropriations Act of 2021, which banned purchasers from entering into contracts with carriers that would prohibit them from accessing claims data, which is quite convoluted for people. People can in this room can probably explain why it was structured that way. And also, as I think we probably all know, there have been lawsuits over the past 4 or 5 years, employees suing their employers, employers suing their vendors, their TPAs, over mismanagement of health plan assets. These lawsuits have generated a lot of opinions. I've heard people say that the lawsuits are going to totally upend healthcare purchasing, that this is the thing that's going to change the status quo. I've heard people say that they're going to go nowhere and they're meaningless. I have also heard the same person say both of those things in one conversation. And so what CHEER's work is doing is bringing clarity to our understanding of ERISA. And it's not just about the lawsuits. There's a broader scope of what ERISA means, what it includes, what it could do, and ERISA, and CHEER is going to help us all sort of come to grips with that. So today and in the publication, which I really encourage you to read and refer to and share, we'll learn about how information disclosure requirements under ERISA can help employers access the information they need to be good purchasers, how the Department of Labor can leverage its authority under ERISA to advance cost containment, and the extent to which fiduciary requirements under ERISA can drive better health plan stewardship. So again, I encourage you to take a look at the publication, to keep an eye out for the publications that will be coming, and I'm looking forward to a great conversation.
Welcome. Thank you all for coming to our event on ERISA, one of the nerdiest topics in health policy. It is a real treat to have you all here. And I particularly want to thank David and the Peterson Center on Healthcare for supporting our work. Their institution is committed to making healthcare more affordable, efficient, and effective, and members of the Peterson team have been real thought partners with us on this work. For those of you who are not familiar with our center, Georgetown CHEER consists of a team of national experts on commercial health insurance. We are dedicated to studying and advancing evidence-based solutions at the federal and state levels that improve the U.S. health system so that everyone can get the coverage and care that they need at a price that they can afford. And so we're going to hear from an amazing panel today in just a few minutes. Before we bring them up, I'd like to set the stage for their discussion. And before I do that, I should note that the event recording is in progress, and the recording and slides will be shared with attendees after the event and available on our website. So, over the past few years, as David mentioned, there's been increasing chatter in the employer health benefits world about whether ERISA, a law that's been around for more than 50 years, is going to fix overspending in our healthcare system by way of a tidal wave of lawsuits driven by new transparency rules and growing concern and awareness that employer health plans might not be getting a very good deal. We wanted to interrogate that idea and also step back to understand what role ERISA is or could be playing to advance healthcare affordability. And I recognize that some ERISA lawyers in the room might bristle at that idea. Healthcare cost containment was not on Congress's agenda when it wrote the law back in 1974. Healthcare itself was barely on Congress's radar then. The lawmakers at the time were really focused on pension and other retirement plans. But the reality today is that ERISA is the main law governing a huge swath of the healthcare market. And tackling healthcare spending and affordability is a big priority for employers and workers alike. And so it's critical to understand what ERISA can do on this front, what it can't do, and what maybe we might want to enable it to do with appropriate reforms. And that's what our new brief discusses, and what we've brought everyone here to talk about today. Before I get into the weeds of ERISA, though, I want to briefly lay out what's happening in the broader healthcare market because it informs what ERISA can accomplish and the policy opportunities that have the greatest potential impact. I assume we all know that employers and workers are spending a lot of money on healthcare, and we're seeing such high spending in the commercial system because of market failures. We have a small number of dominant health systems and insurance carriers, many of which are affiliated with PBMs and TPAs and healthcare providers that profit from ever higher health spending. Additionally, a tangled web of intermediaries has spun off around the major industry players, aiming to extract revenue from the healthcare system while adding administrative complexity and burden. Employers are caught in the midst of this complex web as they attempt to provide affordable, comprehensive health insurance to their employees. And so employers and workers are stuck paying high healthcare prices to corporate health systems, as well as undisclosed and often variable fees and other forms of compensation to TPAs, PBMs, and other middlemen that can go up in tandem with high prices providers or drug makers charge. While employers may know what their total health plan spend is, and maybe how that breaks down by service lines, until recently, few employers have been looking under the hood to really understand what's being paid to whom and why. But that is changing. And that's the first realm of ERISA that we want to highlight. So we've seen significant legislative and regulatory advancements on healthcare transparency in recent years, including 2 advancements that took the form of legislative amendments to ERISA that were directly aimed at giving more information to employers as purchasers of healthcare. These are the service provider compensation disclosure requirements and gag clause provisions. In my perspective, these provisions fit really cleanly within ERISA's framework. A core part of ERISA, as David mentions, demands that employers as plan fiduciaries be good stewards of their health plan assets. And to be a good steward, you need to know what's happening. You need to know how the vendors you hire are getting paid and if they have any conflicts of interest. You need to be able to track where your plan dollars are going and what they're paying for. And so these provisions aim to get employers that information. And as important a step forward as they are, in practice, these provisions haven't been working perfectly. One challenge has been usability. When employers get this information, do they have the resources, expertise, and relevant background information to make sense of it? Can they act on what they learn? Our panel will talk about that. But another foundational issue is basic compliance. And I think the ERISA-ness of these provisions is one of their biggest shortcomings. Because ERISA, for the most part, regulates group health plans. In practice, that generally translates to the employer. And the employer needs to make sure that they get these compensation disclosures, or else they, as plan fiduciaries, can be found liable. The employer needs to make sure their service providers don't have gag clauses in their contracts, or else they're violating ERISA. Yet, it's really the service providers, particularly PBMs, TPAs, who are in control and can dictate what information that the employer gets and when. And so I think it's open to debate just how accountable the service providers are under this framework. I'd say it probably falls somewhere between a little and not at all. But with that said, employers and others certainly do have more and better information available to them today than in the past. And that opens the door to our second realm of ERISA, litigation. Over the past 10 to 15 years, there was a wave of ERISA lawsuits over the excessive fees 401k plan service providers charged. Many of these lawsuits were spurred on by DOL-required retirement plan fee disclosures. And so the question now is whether we will see a similar wave in healthcare with greater transparency, and how that might affect employer behavior and plan spending. And indeed, while I wouldn't call it a wave, there certainly has been an uptick in lawsuits over health plan spending in recent years, and growing concern among employers about what they need to do to be doing to minimize the risks of litigation. The primary thrust of this category of ERISA lawsuits is that a plan fiduciary has breached their duty of loyalty to plan members or their duty of prudence by knowingly or neglectfully allowing their plan to overspend on healthcare, or the plan fiduciary has caused the plan to enter into a prohibited transaction by paying their service providers more than reasonable compensation. These lawsuits, as David mentioned, can be brought by plan members, either against their employers or their plan service providers, or they might be brought by employers against their service providers. The Department of Labor, which I'll talk about more in a minute, can also enforce these provisions. On first blush, this framework sounds promising. Wearing my policy or researcher hat, there's a whole lot of evidence that employer health plans are overspending for healthcare and related services. But while some of these lawsuits will surely reap benefits for plaintiffs, there's reason to be skeptical that they will drive systemic cost containment, at least as the law currently stands. There are simply a lot of barriers to successfully bringing these types of cases. Among other challenges, courts frequently have held that paying higher premiums or seeing your cost-sharing exposure increase year over year, for example, through higher deductibles, is not a cognizable injury when plan members have brought lawsuits. But these are some of the primary manifestations of unchecked healthcare spending. Courts also have found that the defendants, employers, or service providers were not acting as fiduciaries in regards to whatever action is being challenged. So for example, courts have regularly held that negotiations over drug prices and provider reimbursement rates are not fiduciary functions, but instead business decisions over which PPMs and TPAs have full discretion and can't be sued. And so this business decision label, as well as another current PBM and TPA escape valve from fiduciary liability, ministerial functions, can protect a lot of conduct that may be contributing to higher spending. Now, on the other hand, there remain other opportunities where current ERISA litigation could potentially help rein in excess plan spending. One that stands out are lawsuits over the compensation that plans pay to service providers, and particularly hidden or variable fees that they or their intermediaries may take in. There's stronger precedent for these types of challenges, and perhaps we could see more of them making headway in the coming years. But given the challenges to reining in spending through ERISA litigation today, I want to turn to our third realm of ERISA, the U.S. Department of Labor. The department has really broad authority under ERISA that it could be exercising here, from collecting and analyzing information about plan spending and service provider compensation, to issuing more rules and updating out-of-date guidance to clarify how ERISA's fiduciary obligations should apply in the modern commercial healthcare system, to investigating and, where justified, bringing more enforcement actions against the big players in the system who control a lot of the spending. Using these authorities, DUL could set new precedent and potentially influence the outcomes in some of these private court cases to increase accountability. And more generally, the department could start putting more checks on spending. Now, up until recently, we've not seen the department's healthcare resources focused on healthcare cost containment. And that's not to say that they haven't been doing good and important work in health plan arena on things like mental health, parity, and protecting workers from surprise billing. But from everything we've seen over the past several years, they've not really been a part of the larger policy conversation on consolidation, affordability, and spending with HHS, the Department of Justice, and the Federal Trade Commission. But that does appear to be changing. In January, the Department of Labor put out a really robust proposed rule on compensation disclosure requirements for providers of pharmacy benefit management services, and officials have talked about how affordability is a top priority for today's Department of Labor. So I'm really curious to see what comes next. One of the questions is what sort of resources are needed to fund kind of a really full frontal attack on affordability. And just from an enforcement perspective, according to a recent DOL report, the Employee Benefits Security Administration in DOL has only one investigator for every 21,000 benefit plans nationwide. So I've got to ask what's realistic. How much can the department accomplish right now with its current resources? And then what sort of resources or funding are needed to accomplish all of the activities that they could be doing? And so to wrap up, I want to introduce 3 opportunities we see to open the door to ERISA playing a bigger role in advancing affordability. First, policymakers in Congress and DOL could clarify and potentially expand when ERISA's fiduciary duties apply to PBMs and TPAs, and identify examples of compensation schemes or other contracting and business practices that may violate these duties. ERISA's fiduciary framework is overdue for modernization, with special attention on how it applies to health plans and the major players in the system. Second, Congress could amend ERISA to directly regulate more PBM and TPA and other service provider conduct, both to enhance oversight over its transparency requirements and to prohibit or limit anti-competitive contracting behavior and other abusive business practices. These two efforts can complement each other, regulate the most egregious practices we know about today, while strengthening the fiduciary framework to serve as a backstop for addressing service provider conduct that Congress doesn't explicitly regulate. Finally, Congress could increase DOL's funding and authority so that the department can develop more unbiased, independent resources and information to support employers in their role as healthcare purchasers and help employers translate the new data coming their way into action. Even with these changes, of course, it remains clear additional healthcare market reforms are needed to reduce employer health plan spending. But I think everyone here appreciates that there is no single bullet solution to the problems in our healthcare system. And so what I hope you'll take away is that ERISA should be a part of the conversation, and it offers some unique mechanisms that potentially can be sharpened with thoughtful reforms. With that, let me turn the stage over to our amazing panel to weigh in on these issues. Please come up and take your seats. Our moderator is Stacey Richter. She hosts Relentless Health Value, the largest podcast for senior executives at healthcare organizations. I imagine many people in our audience are regular listeners. If you're not, you should subscribe today. Through her podcast and other channels, Stacey uses her voice and thought leadership to provide meaningful insights and inspiration for those looking to do right by patients. Joining Stacey on our panel, first we have Darren Fogarty of the Purchaser Business Group on Health. Darren leads PBGH's health policy work and supports its employer members in understanding, meeting, and taking advantage of their enhanced fiduciary obligations under ERISA and the 2021 Consolidated Appropriations Act. We also have my colleague, Karen Handorf, a full professor of the practice here at Georgetown, former litigator who has both represented health plan participants and fiduciaries in lawsuits against TPAs and spent 25 years working on ERISA for the Department of Labor. And last but not least, we are joined by Timothy Hauser. Before retiring last year, Tim was the Deputy Assistant Secretary for Program Operations of the Employee Benefits Security Administration, and as such was the Chief Operating Officer of the agency. Welcome, panelists.
Thank you so much to Cheer for having us here. It is such an honor to be here with all of you and also our esteemed panel. So what are we actually doing here? We have 1 in 3, 1 in 4 Americans with ESI, employer-sponsored insurance, who are delaying or foregoing care due to cost. That's kind of our baseline. We have employers who are hopefully trying to be good stewards of that dollar, but faced with a very consolidated industry of both intermediaries as well as consolidated health systems who have rolled up into these huge corporate entities. So we've got 3 rounds of ERISA, as Christine mentioned. We've got transparency, we've got the litigation realm, and then we also have DOL oversight realm. And we're going to start out here talking about transparency with Darren Fogarty, who I'm going to ask, Darren, with the now available transparency data and also resources that are made available by PBGH, Purchasers Business Group on Health, what is possible for an employer to accomplish in the pursuit of good stewardship?
Thanks, Stacey. And just thank you to the Georgetown team and Peterson Center for putting on this event. Really appreciate it. As Christine mentioned, my name is Darren Fogarty. I'm an associate director at PBGH, Purchaser Business Group on Health. Makes up about 40 national employers that spend about $350 billion annually purchasing healthcare for about 21 million Americans and families across the country. We support them in their innovative healthcare strategies. We do it in several ways, whether that's leading fiduciary trainings to help them understand their fiduciary obligations and how to take advantage of them, developing best-in-class contracting provisions, developing purchasing standards that have quality and accountability measures, or in the area that I work in now, which is our health policy advocacy. So the picture that I want to paint today, right, is one where employers have strived to achieve affordable, high-quality benefits for their workforce as fiduciaries. And many of our members have really great success stories doing just that. And at the same time, we have to also acknowledge that, as you just mentioned, there are many obstacles and barriers that employers face today. And so refinements to ERISA and other policy reforms play a very important role in unlocking affordability in the U.S. healthcare system. So my final piece of framing before I get to your question is to point out that, right, employers are the only force in this system that have interests that are aligned with the employees and their families. And that is because of ERISA's sole interest fiduciary standard of care and loyalty. So to answer your question, Stacey, we've seen a lot of employer members do a lot of things. They've taken a lot of different actions to reduce healthcare costs. The one that you mentioned explicitly, several of our employer members over the past couple of years have participated in a price transparency data demonstration project where they have taken their own healthcare claims data, mixed it with the public price transparency data, both data sets, hospital and insurer, and also brought in measures of quality, provider quality, hospital safety grades from Leapfrog, and they have brought these data sets together and analyzed it. And what that has allowed them to do is, for the first time, they've had an unbiased look into what fair and reasonable prevailing market rates ought to be. That has been tremendously successful. It's allowed to see them what providers in their geographic markets are providing quality care, which carriers are negotiating competitive prices, where steerage opportunities exist, and it's enabled them to verify in some cases that their direct contracts are in fact competitively priced. We've also seen our employer members have success in selecting new and aligned service provider partners. Our annual survey this year of our membership revealed that over a fourth of PBGH members currently have a non-traditional PBM partner. We worked with our members back in 2023 to construct and publish a comprehensive set of PBM purchasing standards that in many ways enabled employers to set contract terms for their new partners that mirror the legislative and regulatory developments that we've seen around transparency, data reporting, and disclosure at the federal level recently. And importantly, right, what has all this resulted in? Early indications and some projections from these moves show that our employer members are saving double digits on their pharmacy costs and with a better plan member experience. And they are redeploying those into lower premiums for their workforce. I should just say our purchaser members are also importing this contract first logic about focusing on the right contract terms at the start in their medical TPA contracts. And over a third of our members are actively conducting an RFP for that relationship this year. Lastly, many of our members are expanding access to affordable, high-quality care through direct contracting with health systems, with specialist networks, and primary care practices. That's not only reducing administrative costs, which I think everybody kind of intuitively understands, but in the case of direct and advanced primary care, it's resulted in substantial downstream cost savings by keeping employees and their family members healthier and ensuring they get mental health care in a primary care setting, which is very important for a lot of reasons that we could go into, but I won't know. And notwithstanding everything that I just laid out, right, there are still very serious and real barriers to employer doing this work. It's hindered it from scaling as well as we would have liked. Some of those barriers we think can be addressed by policymakers reinforcing ERISA, and others may require additional types of action as well. The gag clause prohibition that Christine mentioned in her opening remarks, in our view, based on the experience of our members in the real world, is really a case study and a cautionary tale that simply amending ERISA to require certain actions by employers without requiring countervailing accountability from their service provider partners will ultimately fail to be effective policy. That has been our experience. Even our members, the largest purchasers in the country, cannot reliably access the data, their claims data, their cost and quality data, to which they are entitled under federal law, as Christine pointed out. That's what makes it possible for a PBGH member who participated in our data project to have to engage in a 10-month-long fight to get their data that they needed to participate in the project. I mean, that actually happened like last year. Relatedly, we see that consolidation in health insurer and TPA markets have rendered them unresponsive to the needs of employers in many cases. As a result, they're often unwilling to give concessions on, for instance, the data access issue. Recently, last year, we worked with 5 of our members to send an RFI out to the market to 47 different health insurers and TPAs nationwide, presenting them a medical TPA contract that guaranteed basic data right access, audit rights, and other reasonable provisions for them to be prudent fiduciaries. Only 10 of those 47 even responded. And the responses that we did get indicated that many incumbent players were unwilling to affirm purchasers' rights to their data or disclose their compensation fully. There needs to be non-compliance penalties for service providers who continue to data block employers. And I think this raises a parallel point, which is that regulators should focus their enforcement efforts in the healthcare space on entities that are contravening the intent of the transparency rules and laws or acting anti-competitively. This seems like a really underutilized tool in a world where employers bear the primary liability for many of these transparency reforms. And lastly, there are some proposed legislation that would modify ERISA in part to prohibit anti-competitive contracting terms that are used by market-dominant hospitals, health systems, and insurers in their proprietary agreements. These are contracts that the employer are bound to in practice, but they're not party to these agreements. And so this type of approach, looking at banning those types of contracting, would begin to defang the monopolistic practices that are employed by the industry. It would also unlock employers' ability to do things with the transparency data that they have, right? Steering their employees to higher quality, lower cost providers, allowing them to exclude an unsafe hospital system from their network. Those are things that in practice they often are challenged by. So I'll just wrap up my opening remarks here by saying, is ERISA up for the job? Yeah, and the answer that I want to give is yes, and self-insured employers are up for the job. And they need ERISA and the law's preemption provision and other policy reforms to continue doing their job. That is how we make healthcare affordable in the commercial market from our point of view. Thank you.
Thank you so much, Darren. I mean, I think it's very clear that market forces favor the market intermediaries, and there is, of course, market failure across many local geographies in the United States today. I think the interesting things that you said is that there are many across the country who believe that saving money is actually worse for members, which is kind of interesting to think about. They just sort of feel like if the plan saves money, the costs get shifted. And I think what we're talking about here is that is so fundamentally not the case if you do the things that Darren was talking about with the transparency data. Like, for example, steering and tiering. The data demonstration project was really interesting, that coalesced pricing as well as quality data in order to actually find the high quality, fairly priced providers in any given geography. But segueing over to Karen here, as Darren said, sometimes what are you gonna do with the information? So you've identified and you want to do a direct contract, et cetera, with a very high quality, fairly priced local provider, and then you find that your service provider signed an anti-competitive contract and you are unable to do so. So we have ERISA, which obviously was built for pensions, but sort of swallowed healthcare. And it, as Darren also said, it leaves intermediaries often shielded from liability. Yeah, so Karen, when accomplishing what Darren, or trying to accomplish what Darren was talking about, how does litigation fit in the picture? Because as Christine mentioned, there is a waive or not waive, depending on your perspective of lawsuits.
Well, I think that the first thing people need to realize is that healthcare is not like the retirement system. They're totally different beasts, and the rules are different, and it makes litigation much more complicated. I will tell you from my own experience, I represented Taft-Hartley plans that tried to get information from their TPA, which was Anthem, and they couldn't get it. And they tried, and they just couldn't get it, even though there were things in the contract that made it seem like they should be able to get it. So we brought a lawsuit, and we got lots of pushback that, the gag clause prohibition doesn't mean anything. It just means you can't have gag clauses, but it doesn't mean anything in terms of the TPA. That, we couldn't have the data because it was proprietary. And so, you try to work on an agreement and you go through months of negotiation, and then they just turn around and don't agree to do it again. And so we brought a lawsuit, and it was still being litigated. We brought it, I think, in 2022. We lost on a motion to dismiss. We refiled a complaint and went forward with that. And before we brought the first lawsuit, we told them about the arbitration agreement and the contract, and they did nothing. And then once we filed the second lawsuit, all of a sudden they wanted to go to arbitration. And so now that the judge said, no, you can't, it's up in the Second Circuit. So they still haven't gotten the data. They were able to get some data, kind of by mistake. Somebody gave them some of the data. And so they compared that data to the negotiated rates and found out in every single claim, they paid more than the negotiated rate. So, but they didn't know why they paid more than the negotiated rate. And it's very interesting because in the lawsuit, we claimed either you're taking the money or you're paying people too much. And they came back with all kinds of reasons why it's possible that they didn't pay the negotiated rate. And they can point to the contract, and the contract will give you like 7 different options for how they can pay what they're paying the provider, one of which was they can pay them more than the provider has billed. So then they say they're not a fiduciary. Well, if they have this broad discretion in terms of determining how much the plan is going to pay, how can they possibly not have discretion? So they argued they're not a fiduciary, you don't have access to this data, and they're really, you have to just fight it out continually. And even those who do fight it out with their TPA will find out that the TPA says, well, you can only get a small number of claims. And if you get those claims, the only people that you can use as a vendor to evaluate those claims are our people, or people that we approve of. And then even if you find out that there's something wrong, you can't go out and collect the overpayments. You have to use us to collect the overpayments. So why is it they want to collect the overpayments? Because they get 30% of whatever the recovery is, even though they may have been making the mistake in the first place. So that's one example of a case that I was involved in that shows how difficult it is to get the actual data. But once you get the data, you have to know what to do with it. And the problem we now have is we don't know how TPAs are adjudicating these claims. You really kind of need the provider contracts to figure it out. We do know there are certain things that look like conflicts of interest, like determining your own compensation by deciding when you're going to collect a savings fee. What if you're collecting it because you just haven't reviewed the claims very well? And no, guess what? You paid too much. So you're going to go after the provider and you're going to collect 30% of whatever you recover. Seems like a conflict of interest to me. And if they were fiduciaries, they wouldn't be able to do it. There are conflicts of interest throughout the system. And for example, you have United owns huge provider networks. And those provider networks provide services to self-funded plans. When you look at those contracts, you find out they're paying their providers more than they're paying other providers. And they're not looking at the claims as well as they're looking at the claims of other providers. There are conflicts of interest that permeate the system. So one would think, well, okay, you should really go after the TPAs. They're the ones that are the bad people. Well, that doesn't work so well either, because there's a couple of things going on. Number one, the case law is it's divided. There are 2 different circuit decisions that seem to go the other way. Number 2, there's old DOL guidance issued when the statute was first passed. It really dealt with retirement plans that says if you're engaged in ministerial acts, then you're not a fiduciary. And the TPAs all claim that they're just engaged in ministerial acts, that you've signed on to their processes and procedures, and that's all they're doing. So, and even if you have figured out that your TPA is bad, the question is, what do you do with that information? And I know of a TPA, a plan, Massachusetts laborers who sued Massachusetts Blue Cross and lost in the First Circuit. They turned around and they sued them in state court. But ultimately, they settled that case because they found out that the TPA they replaced them with is doing exactly the same thing. They have shared savings, they're doing cross-plan offsetting, they have conflicts of interest all over the place. So that's the world you're dealing with in terms of litigation. Then you have the added problem, which in the 401k world, you had participants who could point to where their 401k retirement assets were being diminished by excessive administrative fees and could point to a loss in their account, which was an injury. Well, you can't do that in healthcare. And so you find out that most of the cases brought by participants go nowhere because you can't establish that you've been harmed by the conduct. And even if you could, because the employer has control in its sponsor capacity to determine how much your premium payments are, how much your co-payments are. There's no guarantee that even if the money went back, they would actually go to the participant. So there's no injury. So you just don't have what you had in the 401k area. And on top of it, in the 401k area, you have a plan trust, a fund that you can point to. ERISA doesn't really require that. So I think that there's legions of problems.
Yeah, if I'm just kind of summing up, at the very, very highest level, we have intermediaries whose day job and full business is doing healthcare. We have employers who at best are running a health plan off the side of their desk. So if you just think about that power dynamic and how much someone is willing and able to throw into the mix, plus the market forces, plus the very, very consolidated industry, as Karen just mentioned, there's not that many choices out there, especially if you are a large employer and you need full country coverage. Well, let's move on to our last realm of ERISA here, which is regulatory oversight. So Tim Hauser, if we're thinking about what the possible enforcement actions are or what is possible here from a regulatory perspective, how do you see it?
So first off, let me just say the obvious, which is I've retired from the Department of Labor, so nothing I say probably reflects their views. In fact, just yesterday, I filed a comment letter in response to one of the department's proposals on alternative investments because that rule is such a terrible idea. So I'm definitely not aligned with the department and the current department in many ways. So don't look to me to tell you what they're going to do or how they're thinking about things at this moment. My role in some ways in this group has been to be a little bit of the skeptic of ERISA's ability to push down costs. I don't think that's precisely what the statute was designed to do. But and what I'd like to do is just tell you where I think there are some possibilities for ERISA and where I think there are some significant problems. The other thing I'll do, just so I don't forget before we go on, is, this wave of litigation stuff. There was a picture of a tsunami kind of happening and all this. This is like defense firm advocacy group rhetoric when they talk about the wave of litigation. I mean, last year, according to Encore Fiduciary, which is my former boss's former employer, they said there were about 150 class action lawsuits total. Of those, they said 100 were 401k lawsuits, give or take. So that leaves 50 class actions in 2025. Let's assume all of them involved health plans. I'm sure they did not, but assume they did. The stat was 2.5 million health plans. So if you ask yourself, what does that mean? There's about one lawsuit, assuming optimistically from a plaintiff's perspective that there were 50 lawsuits filed and they all involved health plans, that you had about a 1 in 50,000 chance as a health plan of being one of the entities whose fiduciaries were sued or who were part of a class action claim predicated on ERISA. I don't know. I mean, on the face of it, 1 in 50,000 does not seem like a huge tsunami, does not seem like the world's falling. There's, oh my God, there are all these class action plaintiffs attorneys out there. And we see this kind of dynamic over and over again in the ERISA space, which everyone, you can have a relative handful of lawsuits and all of a sudden we need litigation reform. There's a wave of lawsuits and it's great for the folks in this industry because they market themselves that way. It's good business to scare people about what the realities are, but there is not like a huge amount of litigation going on right now. That's just objectively a fact. Putting that aside, what can ERISA do? On the plus side, ERISA can certainly require more disclosure with respect to the service providers to health plans. The Department of Labor already made an enormous step forward in proposing specific disclosure obligations for PBMs. Congress then reinforced that by providing additional requirements in that regard. I think that may be a little bit of an anomaly under this administration. I think that PBMs are in the unfortunate position of being on the receiving end of bipartisan hostility and animus. They are not popular with anyone as far as I can tell. More generally, this is a fairly deregulatory administration, and I don't know how far they would go with respect to other categories of service providers, but PBMs are one. Another is certainly, especially after the Consolidated Appropriation Act of 26, there's pretty broad authority with respect to service providers that's pretty clear at this point. And in fact, the obligation to disclose direct and indirect comp on a lot of these service providers is statutory. It doesn't even need to wait for a rule from the Department of Labor. But the Department of Labor could do a lot by specifying what kind of disclosures needs to happen in the TPA context in particular to get at some of the issues that Karen was just talking about. Those things would be hugely valuable. Those fall within the scope of the department's authority. I think probably the department should be encouraged to use that authority to do it. I personally, now I'm going to go to my more negative observations about the department's ability to do anything. One, I'm somewhat skeptical about disclosure being the be all and end all for fixing the world or for getting costs down. There tends to be a very naive assumption among policy types and regulators. Oh, we'll just mandate some disclosure, and then somehow we'll let people armed with that knowledge go out there and do all kinds of wonderful things, and everything will fall in place and prices will drop. And if you think about it for a moment, actually disclosure has lots of problems. I mean, one, it's premised on a whole bunch of assumptions. You're assuming that you can actually make that disclosure really clear, and it will give people the information they need. How true is that in the context of stuff like the complex fee structures and practices that we're looking at when you talk about the insurance industry or TPAs? Sometimes I think people have as their mental model like a refrigerator kind of sticker. You can put this easy thing on and it's going to say, here's how much, it costs. Here's what your energy usage is going to be. That's great. But actually, and probably in the health world, like in the retirement world to some degree, you can make the disclosure really simple and understandable, or you can make it true, but you can't do both. And so that's a problem for disclosure. Another problem is you actually have to get people to read and understand that disclosure, and you need to get the right people to read and disclose it. People who can actually use that information and act on it. I don't know that enough attention has been given to that. Here, the thought is that it's probably the employers or the people maybe with the most negotiating leverage, the most power. But is that true? I mean, if these markets like the PBM marketplace and the health insurance marketplace are characterized by huge concentrations of like market power in a handful of entities, even if you have all this disclosure, maybe that will help the employer or the participants better understand how they're getting screwed, but will it actually help them, effectuate better outcomes for themselves? I don't know. It's not clear to me that it will. And third, you have to have some kind of thesis that once this information is out there, you have to have some model of, well, how is that going to help get to a better place? And I'm not sure I know what that model is for these categories of disclosure by itself. I mean, I just kind of wonder about that. And part of the issue is that, the costs in the health system are not just a function of like these negotiations between the employers and everyone else. They're a function of having problems in the insurance pool and of efforts to kick out the people who are, or the incentives for healthy people not to be in the pools, and for provide plans and providers, on the other hand, to keep those people, get those people in and kick out the other folks. I mean, there's a whole range of issues that have to do with the cost and the conduct of patients and physicians and those people, which ERISA doesn't regulate, as opposed to the conduct of of plans and providers. All those things go to cost. They wouldn't be affected by this. The other issues are just now, if you turn to ERISA's fiduciary structure, ERISA is like, when in the health world, it's like a general set of fiduciary standards. If you have discretionary authority over plan administration, if you control plan assets, you're a fiduciary. If you're a fiduciary, you have to adhere to basic standards, prudence, loyalty, most importantly. Those things are very flexible. They can deal with all kinds of situations that may arise in the world, but you have to be a fiduciary or none of them apply. Then on top of that, in the health world, there are a lot of very, very specific obligations that the statute imposes, like the disclosure obligations in the service provider context. And the department does move with those, and it has acted on those. But on the general fiduciary provisions, if you want to use that, they have huge problems in this space for like achieving all you want to achieve. First off, basic plan design decisions or settler activity, they're not treated as covered by fiduciary decisions. Second, a lot of the money that's being spent on healthcare isn't really being spent by the plans, it's being spent by the employers. And you're going to invite huge arguments about whether or not a particular instance of conduct involving overpayments even involves plan assets, and is even the sort of overpayment or that's covered by the statute because they're not plan assets. And even if it is, and even if you can construct an argument that it is, there's going to be a question of, well, what's the remedy under the statute if the
Could I ask you a
person-
question, Tim?
Yeah.
So if I'm thinking about this as kind of a lightning round as we sum
Yeah.
up here, what do you think the most underused authority or idea is inside the existing law that actually could move affordability?
Well, I think that probably the most, two I would point to. One is a class of fiduciary are people who exercise discretionary authority over plan administration. If you are engaged in discretionary plan administration, you're a fiduciary. Those arguments have not been pursued as vigorously as they could. They're not being pursued as vigorously by the department as they could be. They're not being as vigorously pursued by private actors as they could be. It's very, very hard to make out those claims, however, right now, and it's fairly easy under existing law to kind of structure your arrangement around being treated as exercising discretionary plan administration. But as Karen pointed out, there is in fact a lot of discretion being exercised by these service providers, and that would be a potential place to go. Does anyone imagine that this administration is going to, however, be looking for ways to expand the scope of fiduciaries? I don't think so.
And then
So-
Karen, what is the single most important thing an employer should be doing right now to avoid the next ERISA headline? Lightning round.
Well, I think employers are, what you have to do is you have to follow the law, which means that you have to look at compensation and figure it out and do whatever you need to do to figure it out, which can cost a lot of money and take you a lot of time. And then you have to consider it. And you have to consider what alternatives are out there, but you have to figure out whether your TPAs are acting under conflicts of interest, how it's impacting it. You have to figure out exactly how you're going to compare one TPA's practice to another TPA's practice. It can't just be per member per month. It has to be more than that. And if you think that your TPA is acting as a fiduciary and they're cheating, then you have to sue them. That's what ERISA says. Now, that's tough because in the Tierra Yacht case, they sued the TPA and the TPA counterclaimed against them and said, well, you engaged in a fiduciary breach too because you didn't monitor us. And that is the basic thing they were supposed to do. You're supposed to be careful when you choose and then you monitor the TPA. So there's risk involved.
Darren, that is a conundrum. Darren, give us some good news here. What are some things that you really want employers to take away from all of this? What is possible right now?
Yeah, I think that, thank you. I think the actions of some of our members are instructive here. I think that engaging in health policy as an employer is really important. We've seen an explosion of interest in that in our membership, and it's been really awesome to see so that they can help inform these conversations with their real world experience. I also think that employers need to be really thinking seriously about getting unbiased advisors. there's a lot of different ways that could look, not just benefits consultants, but working with people that have their interests at heart and trying to think through these complex problems and try to get some strategies going. Selecting partners that are unconflicted, transitioning away where they can from partners that may not be being totally transparent with them and supportive of them being good fiduciaries. I think that's what they can do.
That's some good advice. I think we have time for questions. Thank you, panelists.
Oh.
David.
David Introcaso, been here 30 years doing policy. So not surprising, this is a sobering conversation. So I've spent a lot of time in the last 6 months. Healthcare is international. Reference pricing, transparency. So what? You go from 256 of Medicare to 246 over 5 years. We have a database. Is this even working? Okay.
Yeah.
We have a database, 30 hospitals around the world, 75 to 100 procedures. Guess what? They're 800% less expensive. They're internationally, they're TJI recognized, their quality is the same. China we have 6,100 hospitals in the US. China has 36,000 hospitals. And of course, I'm sure 35,000 you won't want to go to, but there are 1,000 that are as good or better. So next conversation I'd encourage, why don't we get out of the box, Thomas Kuhn, change the paradigm and think about healthcare as an international business. We go overseas, everywhere, the Middle East, Cleveland, Mayo, everybody else. We have 5,000 Chinese physicians trained practicing here. So can we think more expansively?
Is that the
Reactions.
question?
Reaction to thinking more expensively. Think about how, when you're talking to your 40 members, you don't even have to send patients overseas. CalPERS, Hannaford, and other businesses in negotiating have said, okay,
So,
we have these reference prices internationally, try to meet them.
so do we feel like medical tourism or benchmarking internationally has implications for ERISA?
Well, I think it points to one thing, and that is that maybe employers need to look at different ways of providing healthcare to their employees that don't involve networks, because most of the self-dealing is in the networks run by the insurers. That's pretty tough. I mean, there's reference-based pricing, there's direct contracting. Maybe you send people overseas. Maybe we just have to be more novel in terms of how we're going to provide benefits to our employees. But maybe while we're doing it, we need to look at our contracts and look at the contract terms that give your TPA 700 different ways in which to price a claim. Maybe we need to look at why it is our plan doesn't even define how much we're paying out of network providers. It just leaves it up to the vendor who is making money off of it. So I think that we need to seriously look at what our plans actually provide for and what the contracts say, hold the TPA to it. But maybe what we have to do is also figure out if there are alternative ways to provide healthcare to our employees.
Yeah, I think a major point here is that in the healthcare industry makes more money when there's more dollars in the healthcare industry. So across the board, there is just simply, is it a perverse incentive or just an incentive to make sure that there's more dollars in the healthcare industry? And if we're thinking about that as just kind of our baseline truth, then here we are.
Hello. Oh, the young lady can go first.
Okay.
Go ahead.
Hi, Jennifer Dexter with the National Health Council. And I really, Tim, I appreciate what you said about transparency and information, and you can have it right or you can have it manageable. And I think from the patient community, we're constantly fighting throughout the whole healthcare system around transparency that is actually actionable and usable. And I wondered if any of you had any thoughts about how transparency could help patients be better partners with employers in talking about what they want or they need, and how they can kind of be better partners together to create plans and purchasing that actually meets everybody's needs. So how do patients fit into this, I guess, is the whole question.
Who wants to take that? Darren?
It's a good question. I think that when I talk with our employer members about this, I am always super impressed with how in tune they are with what their employees are looking for. A lot of them have implemented Net Promoter Score programs with their new arrangements that they have and are actively seeking employee feedback. I also think that, employers can structure their benefit and design in a way that employees can benefit. So if the employee goes to a lower priced hospital and is allowed to do that under their plan design, then they can share in the benefit. I have seen employers do zero cost sharing and would completely waive member cost share. A lot of them make primary care available below the deductible at no cost to the employee. And so I think there are lots of ways that employers are trying to structure these things so that they realize that asking the employee to change how they have, experienced healthcare is an ask. And so that comes with something, there needs to be an exchange there.
Just adding on to that, I think that's really interesting. And it's also very interesting how there's 136 million, I think Christine said, Americans that are covered by ESI, but how few of them actually realize that it is their employer who is providing the health plan. And if you have employers who are responding to noise, but those employees never go to their plans, the actual plan sponsor, and create some noise, then I think that is also an adjunct to Darren's comment. I think we have another question over here.
Hi, Sean Grimminger with the National Alliance of Healthcare Purchaser Coalitions. Great conversation, deeply depressing. I have a question that I think will appeal to all three panelists. So as you know, there is a profound disagreement within the employer community about whether third parties should be counted as fiduciaries under ERISA. And my opinion on this is continuing to shift. But I come back to something that Karen said, and I think I just want to understand from a legal perspective, not a lawyer. It is facially obvious that third-party administrators, PBMs, and others are exercising significant amounts of discretion over plan assets, right? When you're overpaying, when you're paying above the billed amount, and that's outside of your contract, you have clearly exercised discretion in a way that benefits you and doesn't benefit us. How is this not plainly obvious to any judge? Like, how do we not get over this, what seems like a very low hurdle to say, like, these guys are literally, they are fiduciaries every single day, and they're engaging in prohibited transactions every single day. How are we not there yet?
So I think I like sobering better than deeply depressing. Let's call this actionable insights.
Well,
who wants to take this question? The lawyer?
Well, I think that part of the problem is that, you go back to the 401k litigation. Plaintiffs didn't win at first. They lost a lot. And I think that you're seeing the litigation develop. The big first case was Blue Cross Massachusetts. They didn't really know what was happening behind the scenes. They just knew there were mistakes. And so the court looks at it and go, well, they just made mistakes. They're not really exercising discretion. If they knew what was really going on and it pled what was really going on, the court might have reached a different conclusion. And I think that that's what happened with Tierra Yacht. Tierra Yachts comes around and it knows a little bit more, even though it certainly wasn't able to get that information from their service provider very easily. And so they were able to say, well, this is what they're doing with the money. But I think that the First Circuit in particular was very concerned about upsetting the world as it is, that if they made TPAs fiduciaries, then the whole business would go away and plans would be hurt. And that was part of the amicus briefs that were filed in that case, went that direction. Well, maybe that is what needs to happen, is that the whole world gets upset. But I think that the more information that comes out about what's really happening undercover, the more likely it is courts are going to find them to be fiduciaries. And particularly employers, now you go back and you look at the litigation, the discovery. The TPAs are not giving them the information. There are discovery fights all the time. But once that information keeps coming out, I think you're going to see a change. But it would help if the Department of Labor would clarify certain things like it's a ministerial exemption.
So on discretionary plan administration, I mean, a couple of things to remember about how ERISA's fiduciary provisions are structured. One is you're only a fiduciary to the extent you're engaged in these activities. So if the way the TPA is making the extra money is by exercising discretionary authority over plan administration, and that results in it getting more money, that's a potential claim, but you kind of have to go through that analysis and show it. And they tend to argue that, you know, we've written our contracts in such a way that we're never really exercising that kind of discretion. It's not really true in a lot of cases, but you have to get past that. And it's not so easy under the existing standards because it's so very fact specific. The second is if you exercise authority over plan assets, that makes you a fiduciary. And again, that seems like a potential avenue for these kind of claims. But the issue of are they exercising authority over the plan's assets as opposed to their own assets or as opposed to the employer's assets are not, they are challenging issues for the courts. Let's put it that way. And I think all of these things, if you're looking for the department to do things, you have to put things in the context, which right now includes two important things. One, I don't believe, I mean, I could be mistaken, but I don't know that this is an administration that's looking for ways to expand the scope of fiduciary duties. The second is that if you're looking for the department to do stuff, it is a radically under-resourced agency with enormous responsibilities and tiny, tiny amounts of people, and constantly asking the Department of Labor to do more things, write more rules, enforce more laws, do this, that, and the other, when they have, like when I left, we had 590 people total, about one investigator for every 20,000 plan. We lost 40% of our investigators, 30% of our benefit advisors, key parts of the reg function. Just doing the stuff Congress asked that agency to do tends to fill up its load. And there, so, you know, if you want to accomplish things through the Department of Labor, it's not just beside the point. You have to, as part of that effort, you have to give the agency resources and staffing that's commensurate with the size of the task it's been given. And we've come nowhere close to that over my entire career, but now we're like catastrophically far from that point.
And that is probably a really good place to wrap this up because I think we are at time. Thank you so much to our panelists.
Just wanted to extend my thanks to all of our panelists and to Peterson and to everyone who is here today. I hope you came along with ideas of reforms, right? Because I think that's what we're hearing is more action is still needed to make the best use of the law that's out there today. So thank you all. Please take a look at our brief. The recording will be online later today too. Thank you.